There's more red flags. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the Fed's risky bet of an aggressive rate hiking strategy is facing economic challenges as factory prices plummet. Let's over to CNBC, where we picked today's story up with a headline: China's producer prices plunge at the most in 7 years as deflation hangs over the economy. Now, I'm going back a couple of days as we get into our headline story here, because I want you to understand that how factory prices are leading consumer prices lower. And what is important to understand with factory prices is there's two components that really matter. One is the commodity side. So you can see prices at the factory level dropping if commodity prices are falling. But if you're also seeing at the same time they're dropping even faster, it means demand is falling. And that's, my friends, what we're seeing now. As producer price index in May fell 4.6%, marking the steepest year-on-year drop in 7 years, marking what we see as deflation coming out of the China's factories. And that matters because it backfeeds into U.S. consumer prices. Here you can see the producer price index of China against the U.S. consumer price index. One is leading the other lower, and we know because China is the biggest exporter of the world and the U.S. is the biggest importer of the world, what it means is as China exports deflation, well, it eventually hits U.S. shores, and now it's starting to hit the U.S. factories as well. Today, we heard from the U.S. Producer Price Index as it declined by more than forecast based on cheaper gas. And we've been talking about how energy prices are going to backfeed not only into U.S. consumer prices, mainly that's the gasoline, but we like producer prices to be compared to West Texas Intermediate, which I'll show you here in a little bit. But of course, we know that WTI is, of course, the raw material that goes into creating gasoline. So one leads to the other. Wherever WTI goes, gasoline prices fall. Again, it all comes back to the energy sector is driving deflation in the economy, not only just at the producer level, but eventually at the consumer level. The producer price index for final demand decreased, deflation 0.3% from a month earlier. So now what we're seeing is U.S. factories following Chinese factories. From a year ago, the PPI rose or slowed to 1.1%, the smallest advance since the end of 2020. So again, all these signs that we keep hearing about, that there's going to be massive inflation and persistent inflation. One key place we're not seeing it is in the factory sector, not just here in the U.S., but in China and other parts of the world. Goods prices slid by the most in nearly a year. Now remember, we were supposed to continue to see goods inflation. That's changing now. The agency said 60% of that drop was due to the decline in gasoline costs. Services prices inched higher, although not by much, reflecting higher margins at auto dealers. And here you can see the producer price index against crude oil prices, a West Texas Intermediate in red. This is my favorite way to gauge the producer price index, indicating to me that what we're seeing in this chart, that as the red line or as a year-over-year rate of change in crude oil prices heads lower, and of course that is a demand component. When the global economy slows, crude oil prices fall. So as that continues to fall, what it means is gasoline prices fall as well, and then that all translates into lower producer prices, which eventually translate, as we'll see shortly, into lower consumer prices. And here, as we look at the breakdown of the report, we can see that deflation at minus 0.3% showing up in total final demand. But notably, we see final demand goods, it was even worse, minus 1.6%. But look at this, services, only a small 0.2% increase. We've noted that this has come down from that big 0.5% increase back in August of last year and the 0.4 in November. And we're starting to see some signs where this is slowing, and ultimately, this could take the producer price index here somewhere negative in a deflationary mode in the not too distant future if this continues. And Zero Hedge validates that with this chart here. What they note, the U.S. PPI processed goods for intermediate demand is a leading indicator of where the producer price index, this shown in blue, of final demand goes, suggesting that we are indeed likely to see deflation at the factory sector here in the U.S., which is not only validating the fact that energy prices are coming down, global demand for energy prices are coming down, but demand for goods and services is also falling. You get those two combinations together, and my friends, that's where you're talking about a recession, a deflationary recession. The PPI, which is a measure of wholesale prices, has slowed markedly since the middle of last year amid normalizing supply chains. This is something that is about time to got settled, shifting consumer spending preferences towards services, but we're seeing a slowdown there as well and a broader cooling of cost of key commodities. So far we're seeing decline in of what we know, supply chain normalization, all of the backlogs there are getting worked through. We're seeing commodity prices come down. It's only a matter of time now before we see the services sector start to slow, because remember, it follows the manufacturing sector with usually about a 2, maybe even a 3-month lag. But one thing that shouldn't actually be changing with the supply chain is your trading account. As we can note, our CTA-Timer Pro report here has copped up with this tech rally. Told you to buy down here, told you to buy again here. And what did we know in our report today? We put our Wednesday watch list to help you, for a fact, for all of our subscribers, identify some of these key ETFs and index and futures contracts that are low that you should be putting on your watch list. In fact, we got an email just the other day. Somebody said, you have changed how I trade. Instead of having anxiety over this, I now know which ones to focus on. It's made things so much easier. Here you can see on our January 9th report, the machines were massively short. We saw them start to short cover. We again saw this on our March 15th report. And what's really cool is we run historical overlay. So when you see something on our report that says it's low, it's at what we consider, broadly speaking, in range of its historical norms at a low point, tells you what you should be watching. $30, link in the description below. Price heading to 40 soon. Get it while you can. Because here we can see the producer price index by commodity for final demand in red, sure enough, is leading the consumer price index for all urban consumers, shown in blue, the headline CPI. It is one is leading the other at this rate, and you can see the two are generally pretty close together at weight based on this direction and this correlation. What this means is the Fed's 2% target is coming in the future at a time when the Fed actually doesn't think so. We're going to cover more about what the Fed had to say today in a little bit, but let's talk about the energy markets, because we have a headline here of global oil demand to peak before the end of the decade as energy transition gathers pace. Now, I know some of you will have an issue with this, of course, because global oil demand growth will trickle to nearly a halt in the coming years and peak this decade, according to the International Energy Agency. The shift to clean energy economy is picking up pace, with peaking global oil demand in sight before the end of this decade as electric vehicles, energy efficiency, and other technologies advance. But the question is, what happens before the end of the decade? Now, if you have some opinion on that, please weigh in the comments. But let's take a look at today's crude oil inventory reports, because what it's telling us is we're not going to have to wait till the end of the decade for energy demand from oil to go down. It's happening today. Here we can see crude oil inventories jumped almost 8 million barrels, distilled stocks up 2 million barrels, and gasoline inventories up a little over 2 million barrels as well. This is not something you see in a booming economy, my friends. This is something you see in a slowing economy. Now, this isn't due to, of course, a green energy revolution. This is due to a slowing global economy. You're seeing it in the producer price index. You're going to start seeing it in the consumer price index, and it's going to show up in all kinds of other places in the economy. The only place that's not showing a slowdown is the Fed's at least opinion on how high they should take the funds rate. And why, of course, West Texas Intermediate matters, why the energy market matters so much. Even here, we can take a look at crude oil prices on a year-over-year rate of change in blue against 10-year Treasury yields. And we can note that in periods where the blue line is heading lower, that's the year-over-year rate of change in crude, that means yields should be falling. In fact, we almost see that every time here. And now crude has been making a huge decline. Yields aren't falling, at least not yet. And mainly, of course, we can note that that has everything to do, at least in the short term, with the Fed's opinion that rates must go higher. But is there a relationship there? Well, what we can note is crude oil prices, when they tend to fall, also coincide with the Fed cutting rate. Here's a couple of examples that I've circled where the Fed funds rate, shown in red, is on a decline with the energy sector. And all that means is as the economy starts to slow, and worst case even contract in rare situations, as it slows down, the Fed normally looks at the energy market and the other indicators and starts to cut rates. But today, they gave us something interesting. They gave us a hawkish pause, but is it really going to be the last pause we're going to see? Well, I think we're going to see a whole lot more starting the next meeting. And here we can see today the Fed announced that the recent indicators suggest that economic activity has continued to expand at a modest pace as job gains have been robust in recent months and the unemployment rate has remained low. Problem is, inflation for some reason remains elevated, and with that they decided to hold rates at the current amount for this time being. They're going to continue with quantitative tightening, but here's the key part out of this update. They said the U.S. banking system is sound and resilient as tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects to the Fed at least remains uncertain. Well, the reality is Fed and reality is Jerome Powell, they do not remain uncertain. But what they wanted the market to believe here, they really wanted everyone to see this was a hawkish pause. So I want to show you on this next slide one of the most worthless statistics that comes out of the Federal Reserve. It's called the dot plot. It has absolutely virtually zero correlation where the actual federal funds rate goes. But believe me, the media and experts, they love this. They think it matters. And what we saw out of the Fed today was they all aggressively raised their dot plot, suggesting that even though they're pausing today, that they now believe the terminal rate or the highest rate at which they're willing to take the federal funds rate where they think it needs to go is another 0.5%. You can see that on the chart here. And so taking the federal funds rate to 5.5 is now what they think, of course, the board thinks the Fed needs to do. And of course, they don't know what the implications have. Well, we're going to give it to them on economic activity. Here we have the net percentage of domestic banks tightening lending standards for commercial industrial firms of all sizes. And what do we note? That when the blue line is above that horizontal black line, whether it's going up or down, that means banks are tightening lending standards. We have manufacturers, durable goods, and new orders in red. So as lending standards tighten, economic activity in durable goods goes down. Here you can see it in the dot-com bubble, the global financial crisis, the pandemic. And guess what? It hasn't happened yet, but it's coming with a lag. It will eventually hit. And what it does, I think it's going to be rather sharp, and I think it's going to be rather dramatic. Here we can see about the labor market. The Fed seems to be concerned that the labor market's not slowing down. Well, let's take the same data, but this time overlay the 4-week moving average of initial claims. Remember, tomorrow, and we'll talk about this in the show, we'll have the latest initial claims data. But as banks tighten lending standards, lo and behold, people start losing their job. It happened again in the global financial crisis. Pandemic was an obvious one, but for different reasons, and now it's starting to happen again. The Fed saying it's not fast enough. Well, my friends, it's coming. Now, what about the consumer price index? Well, they're not sure about this either, but what we can say is when banks tighten lending standards, and again, this all comes back to where money is created in the economy. If banks aren't originating new loans, new money is not created in the economy. You need new money not only to create economic growth, but to pay on those old debts. Eventually, when there's not enough money, you see spending has to slow down. Debts have to be prioritized. It's just how our system works. And lo and behold, what do you see? Inflation comes down. You see inflation comes down, inflation comes down, and inflation is coming down. And the Fed, well, they remain clueless to how the system that they're supposed to be in charge of works. But sure enough, I imagine in a matter of a couple of months, the Fed's already talking about raising rates. Well, my friends, I think the Fed's done here. I think in the next couple of meetings, there won't be any talk of any further hikes, because as the economic data continues to deteriorate, the Fed's going to sit back, pause, and then aggressively cut back down to zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.